Let's look more closely at the methods of valuation used by venture capital and other investors when assessing the value of seed and early stage startup companies. Valuing a seed or early stage company presents certain challenges. The company is new, has no history, so valuations based on historical earnings and revenue performance are of little use. As the company is so new, management's projections are hypothetical, and they're not grounded in historical performance. So discounted cash flow and other valuations based on projections of future revenues and income are extremely speculative. In the seed and early stages of startup development, sales and earnings projections may be so speculative that they're not taken seriously at all, and may be too unreliable to form the basis of valuation. Reflecting the highly speculative nature and the risks involved, the discount rates commonly applied to startups by venture capital investors are in the range of 25 to 75% per year. As it may take the average high-technology startup 5 to 10 years before cash flow turns positive, the net present value of these positive cash flows can be very small after the discount rate is applied for each year. $1 earned in year 10 with a compound discount rate of 60% applied each year has a net present value of less than 1 cent today. So the earnings of the company can never justify an investment based on a discounted cash flow analysis of the company's projected retained earnings. However, investors do use the discounted cash flow model when valuing early stage startups, but they focus on potential terminal value, the value of the company at the point where the investor can exit and sell shares via M&A acquisition or IPO. Although the cash flows generated by a technology startup may be negligible, the price paid by a corporate acquirer or a Wall Street investor in 5 to 10 years may be substantial and justify an investment when discounted to net present value today. When the discounted cash flow method does not focus on cash flows generated by earnings and focuses exclusively on the potential value at exit, this technique resembles the return on investment method of valuation. With 0 in sales revenue and 0 in earnings, the revenue and earnings multiple techniques value the company at 0. The only valuation techniques that make sense in the seed stage and early stage are return on investment, rule of thumb, and comparable deals. In fact, seed rounds are often completed without setting any value at all. The money is invested as a loan that converts over to equity when a valuation is fixed by the lead venture capital investor at the next round of funding. In the early stage, the company may have some revenues, but little or nothing in the way of earnings. The earnings multiple method is not very helpful in setting a valuation, and the revenue multiple calculation is rarely used. As in the seed stage, return on investment, comparable deals, and rule of thumb are the most useful techniques for an early stage startup. The potential return on investment is obviously critical. Entrepreneurs are sure to meet resistance from Sandhill Road investors if the business plan projections do not show the company growing to IPO candidate stage within a 3 to 5 year period. If the company is not projecting profitable revenues of at least $10 million a quarter within this period, the discounted cash flow analysis may raise serious questions about the plan and the potential upside for growth. The top-tier Sandhill Road venture capital firms are looking for a substantial share of a startup company, normally in the region of at least 15 to 20% of the total shareholding. They're also looking for huge potential returns like 1,000% or 10x over a 3 to 5 year period. When negotiating with lead VCs, it's important to understand where they're coming from. Although it seems to have little relationship with the company, the milestones achieved or momentum generated, the return on investment technique is commonly used by investors in seed and early stage companies. When assessing the value of a startup company, one factor to consider is the liquidity discount. A private company is normally assessed to be worth less than a public company. This is because the stock in a privately held company is not tradable. It's not liquid and is therefore less valuable to an investor. A liquidity discount, perhaps of the order of 25 to 33%, has to be applied when comparing private companies with public companies in the same sector. If two companies were identical, operating in the same business sector, but one had shares that were registered and readily traded on the public stock markets, whereas the other company was privately held, with shares that were restricted from public sale, the value of the private company will be estimated by applying a liquidity discount to the value of the public company. If the share price on the public stock markets valued a public company at, say, $100 million, the value of an identical private company would be perhaps $70 million after applying a liquidity discount of 30%. A valuation method commonly used by venture capital investors when looking at startup companies involves a projection of the possible return on investment. The beauty and intrigue of this method is that a value is placed on the company with little reference to the technology, the team, milestones achieved, or momentum generated to date. In fact, the only information an investor requires from the company is a copy of the capitalization table. With this information, details of the amount of money the investor is injecting, the value of the company at a point in the future, say 3 years from now, and how much the VC wants its investment to be worth at that point, the investor works out how much of the company it needs to own today, and from here it can determine the current company valuation. As an example, the investor may estimate that if all goes to plan, the company will be worth $100 million 3 years from today. At that time, the company valuation is estimated at $100 million, based perhaps on comparable deals, earning and revenue multiples. If the total number of shares issued by the company in 3 years' time is estimated at 20 million, after allowance for future rounds of funding, and the VC wants to own 15% of the company at this point, the investor needs to acquire 3 million shares. If it's going to achieve a 10x or 1,000% return on investment, the VC needs to buy 3 million shares today at a price of $1.5 million. So with 10 million shares outstanding today, before shares are sold in later rounds, this sets a value for the company today of $5 million. The investor needs to buy 3 million shares for $1.5 million. So the share price is 50 cents per share. With 10 million shares outstanding and a share price of 50 cents each, this values the company at $5 million. This return on investment technique drives a large number of early-stage startup valuations. Repetition leads to familiarity, and individuals that are involved in a large number of deals, like investors and corporate buyers, they develop a rule of thumb, an awareness, conscious or unconscious, of what seems to be the market rate for companies at various stages of growth. The rule of thumb may be based on comparable deals, the investor's appetite for the investment, competition among competing buyers, and the momentum generated by the company. Although the forces of supply and demand are expected to set the value of a company when shares are readily traded on the stock markets, the price offered by corporate acquirers usually represents a value somewhat higher than the current price per share. Corporate acquirers usually pay a price 10 to 50% higher than the prevailing stock market rate when acquiring a controlling interest in a company. Additional value is justified as a control premium. If the current stock market price is $10 per share, it's not unusual for an acquirer to bid $11, $12, even $15 per share when buying the whole company. A price premium is regularly paid when acquiring control of a publicly traded company, but this is not interpreted by the courts as a blanket rule that a share representing a minority interest is automatically worth less than a share held as part of a controlling interest. The Delaware courts, where most corporate disputes are resolved in the United States, has refused to support arguments by controlling shareholders that the shares held by minority shareholders are necessarily inferior in value. There may be a control premium, but this does not imply a minority discount. The forces of supply and demand may require a corporate acquirer to increase the offer price in order to buy a large number of shares. But this does not mean the shares held by a small shareholder are automatically junior in value to the shares held by a large shareholder. We'll discuss this further when we look at court appraisals. As we've learned so far, there are numerous techniques available for valuing a company. Some can produce inaccurate valuations in certain situations. Reviewing several valuations produced by various methods and calculating a weighted average may produce a figure that eliminates some of the extreme value assessments. The credibility of the average valuation may be enhanced if the valuation report takes into consideration the most realistic techniques and is prepared by a reputable firm of lawyers, accountants, or M&A advisors. It can be further enhanced by the third factor. A thick, detailed, well-presented report can grab attention. Not surprisingly, credibility will be lost if there are any errors or miscalculations. Before we discuss any specific valuation techniques, let's clarify what we mean by pre-money and post-money valuation. The value of a company following an investment of, say, $10 million is somewhat different to the value of the company before the $10 million is injected and added to the balance sheet. Following the $10 million injection, the company is thought to be worth $10 million more than it was before. Pre-money refers to the valuation of the company immediately before the investment. Post-money refers to the valuation immediately after the investment has taken place. As the company starts to generate sales revenues, valuation methods focused on earnings and revenue performance may start to become relevant. At this stage, the value is often determined by the company's revenue. If comparable private companies in the same sector have recently been acquired for, say, 3 times their annual revenue, it would be reasonable to value your company at 3 times the annual revenue. The financial projections of management may begin to hold some credibility. It may not be long before incoming cash exceeds the outflowing cash, so the discounted cash flow method may be a viable valuation technique. The value may also depend on the type of investor leading the round. New investors, anxious to acquire a stake in the company, will tend to offer higher valuations than existing shareholders. When it comes to a strategic round of funding, a corporate strategic investor will often agree to a higher valuation than a pure venture capital investor. Where venture investors are looking exclusively at the financial return, the corporate investor may consider other synergies and benefits to the parent company. For example, Intel has an interest in driving the adoption of Intel chips and often makes investments in startups developing technologies that will drive the growth in sales of semiconductors. By financing the startup, Intel may benefit from resulting chip sales, but the venture capital investor benefits only in the financial return. on the startup shares. So a strategic investor like Intel may be able to justify a higher valuation than a venture capital investor. Where the VC usually negotiates with management and sets the valuation for early stage financings, a strategic or corporate investor may lead a later round of funding and may have more flexibility on price. When selling shares to investors, selling assets or the whole company, experienced sellers often defer price negotiations and wait for the buyer to become pregnant with the deal before discussing valuation. This approach can prevent buyers getting sticker shock and walking away from discussions before conducting a reasonable evaluation of the opportunity. Valuation is only one component of the deal, and there are plenty of other parameters to discuss before introducing the topic of pricing. However, the buyer often requires some assurance the seller's price expectations are reasonable before investing in the process of evaluating the company. The buyers don't want to invest time and resources investigating the company if the seller's pricing requirements are unrealistic. When raising venture capital financing or selling the company, negotiators representing the seller often wait for the buyer to make the first move and disclose their perspectives on price. This is partly because the seller wants to avoid scaring the buyer away, and there's a chance the buyer may come in with a price that's higher than that of the seller. The contrarian approach is for the seller to make the first move and set a stake in the ground by disclosing an asking price or price expectation. Making the first move, the seller might preempt a low pricing proposal by the buyer. This can speed up the negotiation process by scaring away the buyer and terminating the discussions altogether, or bringing both parties toward a mutually agreeable price. This presentation is designed to provide the essentials of valuation for entrepreneurs. As we've learned, the valuation technique applied in a situation depends on the transaction and the stage of company being valued. After watching the capitalization table slideshow, it will become evident to you there's a substantial difference between the value of preferred stock and common stock. After calculating the value of the whole company, entrepreneurs should take this difference into consideration when calculating the value of an individual share of common or preferred stock. Whether the entrepreneur is selling shares to investors or selling the company to a corporate acquirer, value is governed by the golden rule of supply and demand, and the price tends to increase when additional competing buyers are introduced. The price is therefore not fixed and is open to influence by the sales and marketing efforts of the entrepreneur, the company's management, and the brokers engaged in the process.